2022 has been a year to remember for Europe, and the euro in particular. The biggest story of the year was Russia's invasion of Ukraine in late February. This sparked the biggest land war in Europe in 7 decades, the most serious nuclear escalation since the Cuban Missile Crisis, and the highest rates of global inflation since the 1980s. Before the invasion, the European Union imported 40% of its gas from Russia, the largest supplier. A few months after the invasion, they agreed to cut their reliance on Russian oil, by 90%. This caused energy prices to surge for Europe and the rest of the world. The Federal Reserve was the first to respond to rising prices. They kicked off their tightening cycle just a month later in March 2022 with a 25 basis point rate hike. Since then, they've raised interest rates 6 times, 7 counting December, by more than 350 basis points. They started with 25, stepped that up to 50, and then hiked 75 basis points 4 meetings in a row. This aggressive, consistent pace of tightening sent euro to a record low. The market was hungry for US dollars, and the European Central Bank did not give them a reason to buy euros. As a result, the euro exchange rate, which started the year at 113.25 versus the US dollar, dropped more than 15% to a record low below 95.50. It spent roughly 2.5 months under parity, and by the end of November, it was back above it. Very early on, it was clear that due to its proximity and reliance on Russian oil, Europe would be hit the hardest. Investors grew concerned about growth, raising alarms about recession. Inflation soared across Europe, with the annual rate hitting a record high above 10%. There was staggering increase in prices of everything from milk to bread and eggs. In French supermarkets, egg prices are up anywhere between 15 to 20% from a year earlier. Eventually, the ECB responded to rate hikes, but as of late November, they've only raised interest rates 3 times in 2022, compared to 6 times by the Federal Reserve. Rates in Europe are also much lower than the US, and the ECB appears to be in no rush to change that. Unseasonably warm weather and plentiful gas reserves has eased the pain for Europe, who stocked up before the sanctions. But now, as the temperatures start to drop, will be in for a long winter. Energy prices have come off their peak, but a food crisis could be next. Europe's 2 biggest fertilizer suppliers, Russia and Belarus, retaliated against Europe's sanctions by cutting off fertilizer exports. G20 nations paid almost twice as much for key fertilizer imports in 2021 compared to the year before, and are on course to spend 3 times as much in 2022. Even if Europe finds replacement for all Russian and Belarusian fertilizer imports, the cost will remain high in the same way the gas prices rose when Europe switched from Russian pipeline gas to liquid natural gas, and this will feed into inflation. All of this will continue to have a significant impact on Europe's economy, currency, and monetary policy. Growth across the region plummeted in Q3 and is expected to turn negative in Q4, staging the way for a recession in the first quarter of 2023. There are 3 themes to watch for Eurodollar traders next year. The first continues to be Ukraine and how the conflict plays out in 2023. Will Russia pummel Ukraine with new battalions? A Russian victory won't be good for the euro because it will raise questions about who is next. Or will they continue as they have now and try to wear the Ukrainians down as the weather turns cold and the economy freezes? This will probably have the most benign impact on currencies. Will the Ukrainians win? It's hard to imagine Putin allowing that to happen easily. Or will the Ukrainians put up a stronger fight, forcing Putin to issue an ultimatum, stop, or face a nuclear attack? This escalation would be disastrous for the euro and all risk assets. The second theme is recession. The EU forecasts a brief recession. A downturn is also expected in the US, but comparatively speaking, the US recession will be shallower than the Eurozone. In the European recession, if the European recession turns out to be more brutal than the forecasters expect, and data ends up being very weak, euro will underperform the US dollar. However, if the recession is worse, the dollar will underperform the euro. With that said, ultimately, the outlook for euro-dollar currency pair hinges on interest rates and monetary policy. The Fed has less to worry about than the ECB, but they've also come a longer way. As of late November, the housing market is slowing, but the labor market and consumer spending remains strong, supporting the case for a strong fight against inflation. So while the Fed is set to raise interest rates by 50 basis points in December, they are expected to take interest rates to 5% and possibly even higher, which means more rate hikes in 2023. The ECB is also expected to continue the fight on inflation with more rate hikes, but the prospect of recession means they could act slower and end sooner than the Fed. So in the next 4 to 5 months, the euro should continue to underperform the US dollar. I am looking for a parity to 103 range. Currently, it is still holding below the 200-day simple moving average. It needs to close firmly above the SMA, which is currently around 104 to turn the outlook for Eurodollar positive. As the weather turns warm and summer optimism returns to euro, demand should find its way back to euro because ultimately the reserve currency is cheap and undervalued versus the US dollar. I see a move to 105, possibly 108 near the May high by the end of 2023. I am a firm believer that fundamentals matter. Euro fundamentals have been weak throughout 2022 and we've been leaning into short positions. The same will be true in 2023. Watch the fundamental trends and focus on trades that are in line with fundamentals. That's what we'll be doing for our BK4X members, and that's what I suggest you focus on as well. Have a wonderful holiday and a great trading year. And check us out for more trade ideas and tips at bk4x.com.